You started literally at the verge of the first banking apocalypse that we would ever see.
I almost got it timed perfectly.
Exactly, yeah, because you like a challenge, right?
It's my opinion that a venture capitalist doesn't have to get 99% of their investments right. As long as you don't lose all your money on enough of them, the winners will outshine your losers. We today are not automating the ultimate credit and lending or investment decision. We believe that technology is an assistant to human beings. The actual go decision, we still believe in this and this a little bit, the nose and the heart a little bit.
Walter Gontarek, CEO and Chairman at Channel Capital. Thank you very much for joining me this afternoon. It's a pleasure to have you in person here. Walter, of course, we all understand the job description of a CEO, but what does that mean for you?
Great question. For me, I would think that it's two things. On one hand, it's really pulling my organization forward and trying to be innovative and bringing innovative solutions for our clients, I think is a very important role. So being open to those solutions, being open to innovation and new ideas and new markets. And at the same time, there's a balance and considering what I would call to be responsible and to consider other stakeholder interests, which I'm sure we'll talk about later. But it's really understanding the consequence of the innovation and how it affects either investors, staff, it could affect stakeholders in the business, shareholders in the business, or others. So trying to get that balance right for me is really the key objective as a CEO.
And of course, in last years, you've seen your kind of slice of the market growing in terms of demand from entrepreneurs.
Yes. So why is asset-backed debt discussed so heavily now, which it surely is. And the one reason is that if you think about it, we're in a market today where the valuations of stock markets, of gold, of Bitcoin, of all these risk assets are at near or at their all-time historic highs, right? So risk is priced for perfection. But if you've noticed, we do have some geopolitical challenges, and we have disruptions such as tariffs, which affect supply chains, and et cetera. There are wars going on in the world, which, unfortunately. So all of these could be potential shocks. So I think that one reason that asset-backed debt, I'm speaking very broadly now, those parties that provide that, I think that LPs like the asset-backed debt because they kind of know that the market is priced for perfection. They know that there is mean reversion. At some point, there'll be a resetting of businesses and of the liquidity available. So knowing that they're financing or exposed to an asset-backed investment brings great comfort, and yet still providing that much-needed capital.
Let's talk about the Middle East. What opportunity do you see in the area? I mean, I'm personally very much involved. I go there very often, and I do see, of course, that there is an opportunity. What is your vision there?
I think the Middle East, I think the UAE, Saudi, and the Gulf countries in particular. I also like Jordan a bit. I think that these countries provide an opportunity to, one more time, to bring this technology, to bring this knowledge to a market that is stable in terms of the economy, with very good growth rates, increasingly diversifying, and certainly, let's look at the UAE and increasingly Saudi, is becoming very pro-business and looking to bring in entrepreneurs and bring that spirit. And when those entrepreneurs come, you will find a channel looking to support those dreams and looking for solutions for their funding needs. So it's a very exciting time for us. In the case of the UAE, you have the benefit of English law inside the DIFC and ADGM. So as a lender, we have the comfort of the English law, that we know that we can make our decisions and our investments secured. We know that security is robust because we have the benefit of the English law. There's the beginning of open banking, although it's early days. There are entrepreneurs. And very importantly, we have a market where banks are not serving these entrepreneurs particularly well. I've seen research from Goldman Sachs and others that talk about SME lending and new business lending by Saudi banks, for example, is about 7% of the portfolio at the maximum for a bank. Often it's lower than that. So I don't feel, as an ex-banker and a president of a small bank, I don't feel that banks are doing justice for entrepreneurs in many places around the world. That definitely is the case in the Middle East, and we've had many different examples of that we've seen firsthand. So again, bringing our capital, bringing our solutions, bringing our technology, bringing our knowledge, where there actually is capital there, and there certainly is demand for capital there,
Absolutely.
but somehow they don't seem to be connecting all the time very well. We want to be that connector so that the ecosystem can thrive.
And from what I know about your story, you are very, very focused on innovation from very early age. I mean, you started in banking at 18,
That's right.
and by 29 you were a bank president, which is quite outstanding. What was your journey, and how did it take you all the way to Channel Capital?
Sure. So I had the good fortune of not having enough money for university, if that makes sense, in the sense that that forced me to get a job. I was fortunate enough to work for a bank in one of the lowest positions, which is dealing with the loans that are defaulting and having to negotiate with borrowers payment terms, whether they be first individuals or businesses. And to do that, you have to learn to work with people for a positive outcome that are under stressful situations. And I did that for a number of years. And then the bank realized, well, if you know how to collect the bad ones, maybe you know how to make them. So by the time I graduated from college, I had lending authority within the bank, and that grew over the years more and more. Lending authority because I was making supposedly good loans, if I remember. And you're right. So by the time that I was in my late 20s, I was named president of our consumer banking subsidiary in the US, which I'm about to explain, really forced me to begin to think in a more innovative way for problem solving. And that's a theme and a golden thread that has really followed me throughout my career, whether it be in the US, then the UK, Europe, and now increasingly even in the Middle East.
Tell me more about the experience at the bank then. How
Sure.
did you change?
Yeah, so this was the big change. And I'm not suggesting at the time I understood everything that we were doing and all the consequences, but I tried. At the time, I became president of a banking subsidiary, making loans in the United States and Maryland and Virginia and elsewhere. And the interest rates went up high very quickly, not unlike in 2022 that we had more recently. And the problem is if you're making loans at one interest rate over the years, and it's a good loan portfolio, and your cost of funding goes higher than the interest you're earning, this is not the way the ideal banking model works, right? This is a very bad thing. This is a negative net interest margin. So this meant that every day we were losing money. And we were trying to find solutions, and it emerged that securitization, which was a brand new concept at the time, may have offered a solution. I was lucky enough to identify a book called Breaking Up the Bank. It's still, you can still look at it on, at Amazon today. And it really explained how that by moving assets from an originator's balance sheet and ring fencing them, another funder can come in and look at the assets and say, those assets are of better credit quality than the originator itself. So, and based on the various structures you use, we will purchase it or lend against it at a preferential cost of funding. And this was exactly what we needed at the time in order to move forward with our business and turn things around. And this really, for me, was seeing it work firsthand really opened up my eyes and forced a lot of other changes that I subsequently took in my career.
Fast forward, you moved to the UK at some point, and 2007, you found Channel Capital.
Correct.
I mean, you started literally at the verge of the first banking apocalypse that we would ever see.
I almost got it timed it perfectly.
Exactly, yeah, because you like a challenge, right? That's the whole point. So how did that go, really?
Oh, that's a great question. Of course, you realize when you launched in 2007, you've been working on it for a year and a half, and like now, it was very much a go-go deal-making environment. But by the time you launch, what happens is the climate begins to change, and you can feel the creek starting to emerge. And we were launching, and we created a company which I don't want to use the word insure, but in essence, took the credit risk from the banks exactly when the world was facing this GFC situation, exactly when they were hungry for capital. And we were there with a brand new balance sheet. We had very good credit ratings. We had a very good reputation in global banking centers. And we were able to essentially assemble a portfolio of about $12–13 billion that we were able to source from the banks at very good quality and pricing for my investors. So that was a really, in a funny way, it was the best time to launch notwithstanding the overall environment, was not a good time.
Yeah. Well, we are now in a few years, close to almost 20 years of this business, right?
Yes,
So
yes.
how did it evolve in terms of structure, in terms of focus, in terms of offering?
Rather than now going to banks to source credit risk, and now we're sort of evolving to where channel is today and the markets that we've been heard about all day today, we changed our model from sourcing the credit risk and the assets from the banks, which is called today SRT. So this model has continued, although it's changed in its structure. We now go directly to the borrowers. We go around the banks and we deal directly with the borrowers. So the answer to your question, the biggest change to date has been you go from being a stock picker, you're selecting assets and you have to argue over the price, but you can select a lovely portfolio from the banks. Now you have to go knock on doors and you have to meet real living people and meet entrepreneurs, and you have to negotiate terms and you have to help them grow their business and yet defend and protect your investors' interest, which is your first responsibility. So that is actually a bigger challenge, I think, than what we did the first time.
Can you give me a bit of an overview of what you see right now in terms of products, how you channel serve your clients, venture debt, normal debt, just maybe a roundup of what is available and what you think is a winning product and why it's better than equity?
Now, it's my opinion that a venture capitalist doesn't have to get 99% of their investments right. Because if you think about it, if they get 10% of their investments right and they become unicorns, they become very, very successful for their fund returns. As long as you don't lose all your money on enough of them, the winners will outshine your losers. Debt is a very different thing. With debt, we need very high percentages of getting our principal and our interest back. So when you move away from that venture capital model, you have venture debt, right, as the first starting point. Then you have asset-backed debt, in my opinion. You have the next stepping stone, next stair. And then beyond that, you might have direct lending, which is very prevalent in the United States and in Europe. We can touch on that if you want. And then you have longer-term infrastructure debt. So this is the rainbow of the debt products, and there would be other versions of that. Then when you move on to asset-backed debt, that's a very different thing. That is where entrepreneurs, again, are supported completely with non-dilutive capital in the way we do it, but we're buying assets. So we're being very protective of our LPs and our investors. We own assets that we take from the borrowers, and we own them in the fund. That could be receivables, it could be inventory. We might buy GPUs, we might buy software, we might have the leasing contracts, we might have the revenue flows, and we own those. And in return, we provide funding to the originator. So again, for that piece of the life cycle where they're not a brand new startup, they're not yet investment grade for sure, but they're about to have a spurt of growth. They're about to be halfway towards a unicorn, and they need funding for 1 or 2 years. It's a bit expensive, like venture debt, asset-backed debt, but it's not dilutive. It's a really good potential solution for entrepreneurs. And then as you move on that spectrum that I mentioned before, then you have the longer term 4 and 5-year direct lending products, much bigger companies, global companies with very big levels of sales and revenue and hopefully profits. And that's a whole different sector of private debt. And then of course infrastructure after that.
So Walter, we look at Channel Capital, but it's actually owned by Channel Digital.
That's
Do you want
correct.
to tell me more about that?
Sure. So Channel Digital is the holding company, and the asset manager is the core and the focus of what we do. But we do have a technology subsidiary that we develop technology for our clients and in order to make our lending more efficient. So maybe I could just talk a little bit more about that. We use things such as AI and different types of models. We use information from open banking. We use a lot of alternative data from different unique sources that we collect data from. And we try to understand the lending risks we're taking, and also we continue to monitor with those. So our philosophy with that is that these tools, AI or other tools, are all an assistant to the analyst. They help the analyst work faster, work more efficiently, make less errors ideally, and hopefully be a little bit more predictive in terms of the future possibilities of the portfolio and identify risk faster. So this is the role of Channel Technologies, is to develop this.
One more topic on technology. You mentioned before stablecoins.
Mm.
What is your view on that, and how is it going to be disruptive or changing the industry?
I mean, if last year was the year of AI, this year feels to me potentially like the year of stablecoins.
Absolutely.
We believe that stablecoins has the potential to become an alternative highway to transmit money internationally and for international trade. But we think stablecoins will be, with stablecoin wallets and the ability to quickly, within moments, being able to transfer funds around the world and support our clients as they move around the world and they have trade around the world and they're selling products around the world. We think it's going to be a really exciting time. So we definitely foresee, I would say conservatively, within the next 6 months to a year, a USDC or a stablecoin asset-backed security, stablecoin loans, and we want to be part of that because we think, again, it's making us more efficient and it's better for our clients.
Walter, as we drift towards the end of this conversation, I just want to play a little game. So I'll ask you a couple of fire questions, and then you tell me either choose one or the other. And of course, if you want to give me like a just brief explanation. So, debt or equity?
If I'm a business owner, I would rather use debt responsibly than equity because I want to keep the equity in the hands of my existing owners. I do not want to dilute myself, and I want to use debt in a very careful, prudent way so that my company can grow and then raise equity at the higher valuation. So I think debt is the right answer.
Speed or precision?
I believe precision is really important. I think you can always go back and try to increase the speed and velocity of things, but trying to get things right most of the time is really a noble cause.
And speaking of noble causes, just one last question. If you were to be remembered in the industry or as a professional, what would that be about? What is your legacy?
I would say one of the things that I've enjoyed greatly, and working from home and post-COVID has made this quite challenging, frankly, would be the opportunity to work with younger people. Over the past 7 or 8 years, I've been a visiting fellow at a number of universities in the UK and one in France. And working with younger people, they force you to get out of your comfort zone and reevaluate your assumptions all the time. And then in the workplace, you see an instant reward when you see someone, they're growing and they're learning, and then they're showing leadership and initiative. It's tremendously rewarding. I know I would not be where I am now if some people did not take some interest. Sometimes it's not a very formal mentoring program. It's not we meet every other day at 9 a.m. It can be quite informal, but it can be very effective. And to the extent that I can return that, ideally in the workplace with my staff and my teams, or alternatively even in the classroom occasionally, I think it's personally very rewarding.
Walter, insightful, energetic, and I think I learned a lot. Thank you so much for today.
Thank you.